Well, ladies and gentlemen, Happy New Year. This is Grant's Interest Rate Observer of the Air. I am Jim Grant, and we are coming to you from 233 Broadway. Yeah, that's in the Woolworth building. We have moved back, Grant has moved back to the place where we started, which I guess, I don't know, does that represent progress? Well, we'll find out. With me today, as usual, it's Eric Whitehead in the dials, the great Evan Lorenz, the deputy editor of Grant's, and Phil Grant, who writes and propels into the ether, into the digital ether, the almost daily Grant, the indispensable, almost daily summary of things financial. So, gentlemen, welcome back to the new year. And ladies and gentlemen, welcome back to Grant's. We've been on vacation, and then we came back and we did some typing, and we just published a new issue. And I don't know, how do you think things are going, Evan? Speaking as an employee of mine, pretty good?
Perfect.
I would concur with that.
Yeah, we have a few things on the agenda today. I think that Evan has a few words on the state of the restaurant world. And I, for my part, have a couple of things to get off my chest. And among those things are grateful words to our sponsors, which include Pitney Bowes and ZipRecruiter. And more about them in a moment. But first, Evan, did you see this is just new on the Wall Street Journal. I think it's only up on the website, but there is a story about lack of women in the economics profession, the inhospitality of that profession towards women, and questions raised by Ben Bernanke, PhD, and Janet Yellen, PhD. What are we going to do about it? And all this got me thinking about economics, economists, their conceits, and the nature of diversity in central banking. And this might take 45 minutes or an hour. This is a very important set of topics. And I'm going to begin with an economic observation that, Evan, you called my attention to this morning, which is that Jerome Powell himself, chairman of the Federal Reserve Board, is saying there's not going to be a recession in 2019. Is that a correct quotation, Evan?
Yeah, he basically said there's no chance of a recession this year.
Yeah. Evan, what is the National Weather Service saying about the chances of a hurricane in 2019?
I'm sure they're saying there'd probably be one.
Yeah, I suspect in the humility of physical scientists, they're saying it's indeterminate at this point. The contingencies and complexities being so great. And bear in mind, this is the National Weather Service that makes like 77 billion observations of data a year. Has computers, the power of which is 10,000 times a Dell on your desk. And I don't know. So Jay Powell, not exactly an economist, but investment banker and lawyer doing business as an economist, is guaranteeing no recession. It's like, what did Joe Namath guarantee the Jets' victory?
1968, Super Bowl III.
Yeah. Namath was correct. We'll see more about Jay Powell's call. But I say, to start with, that it's foolhardy and irresponsible to claim anything having to do with human affairs a year out. Just ridiculous. And Evan, I think you sent me, I confess, ladies and gentlemen, I am not at 233 Broadway, although I am paying the rent. I am in Sahara, New York, where it is 8 degrees above zero and the wind is howling 18 miles an hour. That's where Eric Whitehead actually wants to be, because Eric, as you know, Eric is disappointed that he can't go to Pyongyang.
He's nodding right now in agreement.
Yeah, apparently there's some difficulty with North Korean-American relations. But Eric, the Somalia, I gather, is available. There's a days in Somalia.
Probably a little more temperate.
Yeah. But anyway, I think I saw, and that economists elsewhere outside the Federal Reserve Building are saying that the risk of recession is the highest
in 6 years. This is what Bloomberg says. Yeah. Analysts surveyed by Bloomberg over the past week see a median 25% chance of a slump in the next 12 months, up from 20% in the December survey.
Well, we'll know more in, 4 or 5 years, I guess we always say. Finally, on this question of diversity, this is a little bit of a sore point around here at Grant's. And I refer the readers of Grant's to the issue of our journal dated May 20th, 2016. And the headline is For Monetary Diversity. And the burden of the piece was that kind of diversity that would leave the monetary establishment constructively rattled. The economic establishment is seemingly undisruptible. It is either governmentally sponsored or academically protected through tenure. So I'm not going to a paragraph, and you're going to have to listen to it, ladies and gentlemen, because that's what you signed up for. Okay, here it is. What's wanted is a call to the kind of diversity that would leave the monetary establishment constructively rattled. Let the new hires, Hispanic, African American, Asian women, men, what have you, demonstrate an independent turn of mind. Let them question 21st century dogma. Who says that falling prices are intrinsically bad, or that the definition of stable prices is a 2% rate of inflation? Who says that ultra-low interest rates stimulate business activity, or that administered rates are better than the ones markets discover? Require professional-level job applicants to address the following question in an essay of 500 words or less. What's money, and who says so? Yeah, that is the grants interest rate program for it. And I know one thing about it. It ain't going to be adopted at the Federal Reserve. That's my one certain prediction for the year 2019. Anyway, that's the end of the sermon, Evan. And before we hear from you concerning McDonald's and other such important market-moving topics, I want to help our listeners understand a few things about our sponsors, Pitney Bowes. And the thing we're promoting on the part of Pitney Bowes is something called SendPro Online. Now, this is an online software that helps you save time and money no matter what you send. Letters, packages, overnight, flats, angry letters to the editor, what have you. And you'll always pay the right amount. It comes with a free 10-pound scale. Now, isn't that kind of a heavy piece of machinery?
Yeah, certainly is.
Oh, you know what? I
think it only
think
weighs up to 10 pounds.
Weighing up to 10 pounds, yeah.
It might weigh 10 pounds itself. It's really unclear.
I don't think so.
Okay.
Well, anyway, what we want is clarity in the copy we read. It comes with a free 10-pound scale that weighs and calculates rates for you. Plus, you can compare options between UPS, USPS, and FedEx right at your fingertips. So on January 27, 2019, the Postal Service is going to put up rates, unlike the Fed. But just by using SendPro Online, you get discounts up to 40% off Postal Service priority mail shipping and get 5 cents off every letter you send. No additional equipment needed. Just log onto your computer and use your own printer to print shipping labels and stamps. SendPro Online is only $14.99 per month, and listeners get a free 30-day trial when you visit pb.com/grantspod. That's PB, that's peanut butter. Not peanut butter, but pb.com/grantspod. You'll get that free 10-pound scale that might weigh less than 10 pounds, and it'll ship to you at no additional cost to help you weigh your packages and letters. Experience the convenience of SendPro Online and try it out for free at pb.com/grantspod. You know, my old editor at Barron's, well, he wasn't old then, but my former editor, the late Robert M. Bleiberg at Barron's, issued a kibosh on the word experience. And he had this great booming stentorian voice, and he'd say, "We don't experience anything at Barron's. We enjoy it or we suffer it." You know which one he preferred. Yeah, that was then. So, Evan, tell us about what is happening at McDonald's.
Well, so McDonald's, just to frame everything, has one of the most profitable franchisee systems in America. Its restaurants typically do some of the highest, dollar volume of any of the brands out there. And the franchisees have not been happy. In fact, a recent survey says nearly 9 out of 10 franchisees in the survey said they were unsatisfied with their cash flows, including 69% who said they're very unsatisfied with their cash flows. And the reason why this matters is if McDonald's franchisees aren't doing good, it pretty much means that most franchisees aren't doing pretty good. One issue that Grants has been focusing on in the last 2 years is the very high multiples that Wall Street has afforded to franchisors who collect a royalty stream and the deterring economics of franchisees. The bad blood between McDonald's and its franchisees has actually gotten so bad that last year the franchisees formed their own independent franchisee association that is not associated with McDonald's. And this week, that franchisee association sent an email to its members saying, to put it bluntly, stop everything that is not currently in the works. They're essentially telling McDonald's that we're not going to do any of the renovations that McDonald's is hoping they'll do in order to boost sales, in order to boost the royalty income they're getting. And just to give you a backdrop of what's happening in the restaurant world in general, TDN2K is a data analytics company focused on the restaurant industry. They announced today that December same-store sales for the entire restaurant industry grew 2%. And this is them saying this was the highest since August of 2015. Simply 2%, basically meeting inflation, is the highest sales growth that they've had since 2015. So the industry isn't really growing. There's been a lot of expansion in terms of new restaurants, and the franchisees are basically starting to buckle under the expectations that they keep investing and reinvesting in their stores in order to basically put up, inflation or sub-inflationary growth.
The other takeaway, of course, which I guess Evan Evan already kind of implied, is that, just to say it directly, is that if McDonald's franchisees, the cream of the crop, if the franchisors are struggling, then what does that leave the second tier, the third tier? Probably not in any better shape.
And this actually circles back to something that John Hamburger, the president of Restaurant Finance Monitor, said at the Grand Spring Conference. Essentially, you can't have all the economics tilted just on the franchisor side. Essentially, something has to give, and it seems like now's the moment where this is starting to happen.
What is happening in Canada? There's certainly no love lost between the franchisors and franchisees in some of the establishments.
Tim Hortons was the big one.
Yeah, there's been a long, slow grind there. Tim Hortons, which is owned by Restaurant Brands International, which also manages Popeye's Kitchen and Burger King, has been kind of in a long slugfest with its own franchisees. 2 years ago, the franchisees formed their own association. In retaliation, Tim Hortons has actually yanked the restaurant of the founder of the independent association away from him. There's a lawsuit in the works where the franchisees are alleging that the company misused, amongst other things, ad dollars and basically have padded their own bottom line at the expense of the franchisees. That's still working in the system, but that's another long, slow burn. And Tim Hortons is kind of like the McDonald's of Canada. It's a very large association with very high unit volumes. And again, when you see something like this, the leaders of the pack suffering, then it doesn't really bode well for the rest of the industry.
Yeah. Hey, we had in Buffalo, New York, there was an event on Wednesday evening. It was an event staged at the Albright Knox Gallery, which is one of the premier art museums in the Northeast. Indeed, I think it's one of the premier art museums in the country. And the reason for it was, it was kind of a deeply contrarian meeting of the following three organizations: Jeff Gundlach, money management firm DoubleLine, and Barron's and Grants. And most interesting were Jeff Gundlach's remarks on what he sees coming ahead. And Phil was there too, and he might correct me or add to this, but Jeff was kind of intriguingly, prospectively bullish on emerging markets. He sees that in a kind of a technical analysis, he made the case that EMs might be making an important bottom, and that if the dollar weakens as he expects it might, these things are all couched in possibilities rather than certainties. We might see surprises to the upside in things that are sensitive to the dollar exchange rate, like emerging market equities. That was one thing. And after the hour and a half program, the word gold had not having come up, somebody asked Jeff about his view, and he said that, that he one of his main calls in the new year is GDX, which is, of course, one of the ETFs for gold bullion. So that's kind of cool. And afterwards, from far and wide. I mean, they came from middle of Pennsylvania, and we had one guy from Michigan, very flattering. And one of the farthest traveled contestants was Jonathan Pfluger, who was a chief strategist at Barron, which is a public affairs outfit in Washington. I think lobbying is what public affairs mean in this case, but Jonathan is the chief strategist. And he said, would you please incorporate in every podcast a book idea? I said, oh, good. That's a good idea. So what are you reading? So what I'm reading is something called Sovereignty and an Empty Purse. And the author is Bray Hammond. Bray Hammond is the author of the Pulitzer Prize winning, truly magnificent history called Banking and Politics in America? Banks and Politics in America, won the Pulitzer Prize in History in 1958. And the lesser known of his two major works, Sovereignty and an Empty Purse, is about banks and politics in the Civil War. And this might seem a little bit far afield. I should caution everyone that this is a book you have to get in an online book service like Abe Books. It's way out of print. But you can get a copy if you're really so motivated. But I'll give you one of the highlights. Bray Hammond, the author, quotes an advisor, a Jacksonian. I'm not sure if he's an advisor to Andrew Jackson, but he was of the Jacksonian school of monetary thought, which is that there ought to be no centralized meddling in the world of money and credit. And here's a direct quotation from the aforementioned Mr. W.M. Gouge. All right. Having separated itself entirely from paper money banks, the United States government is no longer responsible for the evils they produce. For the correction of those evils, the people must look to the state governments by which these institutions, that is the banks, have been created and by which they are sustained. The action of the U.S. government is necessarily negative in its nature and consists in having nothing to do with the fabrication of paper money. The less governments has to do with banks and the less banks have to do with government is better for both. All right, so that's the wisdom of the ages as expressed in the middle of the 19th century by Mr. W.M. Gouge. A crazy idea that seems to have been wearing better these days than it had for some decades previous. And I'll quote one last sentence by Mr. Gouge. The separation of the monies of the government from banking institutions is indispensable for the safety of the funds of the government and the rights of the people. Period. Close quote. Bang. Yeah. So, which reminds me of ZipRecruiter. I don't know. It just does.
Nice.
Yeah. So, you know what's smart?
What's that?
Kicking off 2019 by planning out which roles your business needs to hire for. Well, that sounds, which reminds me. I wonder which of you guys are filling the proper role that we hired you to fill. I'll think about that later. But so what else is smart? And this is, the script says, I have to read this. So here it goes. You know what else is smart? Well, starting the new year off strong by going to ZipRecruiter.com/grant to hire the right people. Unlike other job sites, ZipRecruiter finds qualified candidates for you. Its powerful matching technology scans thousands of resumes to identify people with the right skills, education, and experience, and actively invites them to apply to your job. So you get qualified candidates fast. That's why ZipRecruiter is rated #1 by employers in the U.S. This rating comes from hiring sites Trustpilot with over 1,000 reviews. And right now, our listeners can try ZipRecruiter for free at this exclusive web address, ZipRecruiter.com/grant. And if you love this show, and Evan and Phil and Eric, you do, right?
I love this show.
Yeah, okay. Good. Okay. Just wanted to make sure. If you love the show, show your support to it at ZipRecruiter by going to ZipRecruiter.com/grant. G-R-A-N-T. It says spell out grant. I could do that. I've had practice. That's ZipRecruiter.com/grant. ZipRecruiter, the smartest way to hire. So here we are at a new address, a new year, and you're supposed to have new ideas, right? I mean, that it says that somewhere, that every new year you must have a set of new ideas. And I was on CNBC a couple of weeks ago, and I was taxed by one of the on-air personalities with the absence of new ideas. In fact, I could, between the lines of the question, I could detect a certain sarcasm about my predictable line with respect to credit, phony interest rates, and the consequences thereof. So my new idea for 2019, defiantly, is the same damn idea we had in 2018, which is that 10 years of suppression of interest rates have consequences, the nature of which are apparent, but the details of which are forever interesting and are likely to be forthcoming throughout the year. What do you say, Evan?
I think it's good. I think we should commit to new ideas when there's a new Fed.
Right, when things actually change. Somewhat to that point, speaking of the interest rate expectations, I looked up the effective Fed funds futures rate on Bloomberg today, as I have started to do on a daily basis, and for good reason, because as of right now, the October 30th forward contract implies 19% odds of a rate hike and 7% odds of a rate cut. Just a week ago, the same contract, we were looking at rate hike odds of just 6%, whereas the odds of a cut were 17. That's, again, a 1 week lag time to basically flip our odds.
Yeah. Well, this is the, not giving away too much to those who have not yet subscribed to grants, but the page one piece of grants was in part about the extraordinary volatility of expectations. Evan, you help me out here. At the stock market highs of September of 2018, the imputed odds of a rate cut in the December 2019 Fed funds contract was, I think, 1%, no?
Yeah, it was around 1%.
And so fast forward 6 or 8 weeks, I guess, and the stock market's a little choppy and a little bit downdrafty. And along about Christmas time, the odds imputed for a rate cut in the same December 2019 contract was in the order of 45 or 47%. Now, to me, what is interesting about this is it flies in the face of the received dogma within the central bank that inflation expectations are the thing to be managed. They must be anchored, goes the argument. Well, what's anchored about the market's expectations for Fed action? The Fed contends that its action is dispositive with respect to the rate of inflation after a suitable lag. But I don't know, Evan, I'm starting to think that the stock market is really the thing that sets expectations. The Fed watches the stock market, and the stock market watches the Fed. And my conclusion, Evan and Eric and Phil, is that because the stock market is watching the Fed, and the Fed is watching the stock market. What people really ought to watch is Grant's Interest Rate Observer. You guys with me?
Yes. Genius.
Huh? I can't hear you.
I think it's a fantastic idea.
Right again, sir.
Yeah. Well, ladies and gentlemen, welcome to 2019 at Grant's. And I don't know, it's a pleasure to be around. And I just signed a 10-year lease at offices at 233 Broadway. And I forget, Phil, you're in the family. Wait, I'm 52 or so. Oh, no.
Yeah.
I'm 72 years old, just signed a 10-year lease, and people call me